winning all day. Today was pretty awesome. US 30 struggled there a little bit in the afternoon, which I'm going to talk about. I'm going to train. I'm going to show you guys the tools you have on how to maximize alerts and also how to use filters. We're going to talk about when to trade, because there are certain times of the day that are not ideal for trading certain instruments. We're going to definitely talk about that. So this training is going to be a little bit off the cuff. I don't have a bunch of pretty slides. However, we will be building a slide deck to go through the exact same information that we're going to be covering here. But I wanted to just go straight to the charts to start showing everyone a few things. So first off, let's talk about the whole idea between stacked and REV, because when we first announced in Miami this update, we were referring to the system as the stacked alert system, and we had 6 different types of alerts, and we were going to have different labels on every alert, and it made sense, and we had everything built, everything ready to go, but as we were waiting for the integration, we continued to optimize, and our internal team started thinking if it was possible to further simplify this new upgrade, so that instead of having 6 different labeled alerts, that we can narrow it down to just 2 alerts. It still has the same computing power, the same opportunity, but simplify it. And one of my personal philosophies is simpler is always better, especially when you're dealing, with a large community like ours. And so we sped the engines up. So we took the 4 engines that we showed in Miami, and we sped up the computing power, and we were able to combine the entire system into 2 engines. And we were looking at the continuation of trend alerts, and then we were looking at reversal alerts. Okay, and reversal alerts, obviously those were different than the counter trend alerts. So for those of you that were in Miami, or you were on some of the previous webinars, you know exactly what I'm referring to. And what we realized is that a really good continuation of trend alert, it's still a reversal, right? Because a continuation of trend is when the market's trending in a certain direction, there's a pullback, and then price starts to go back towards the direction of the trend. Well, that pivot point of the pullback and then the continuation, that's still a reversal. It's just a smaller scale reversal. Now, in the world of trading, the common term, or I should say the appropriate term that's used to describe what we have here, are extremes and locals. Okay, so for those of you that have ever, if you ever used a trend channel line indicator, maybe most of you probably haven't, but a trend channel line indicator is an indicator that draws trend lines for you on the chart. If you've ever used one, then you know that the settings inside the trend channel indicator are local trend lines and extreme trend lines. And that's because you have your large outside trend lines, and then you have your small inside trend lines, right? So for example, if I were to show you on this chart what that means, and this will help you understand the alerts, that's why I'm explaining this. But if I were to show you as an example right here, it might be a little hard to see, but there's like a trend line that you can easily use to connect this bullish activity here, right? And this would be considered a local trend line because it's up inside the consolidation areas of the chart. And if I were to draw a different trend line that is bigger, okay, like let's say, here's a good example. Let's say from this sell alert here, touching these points here, okay, that would be considered an extreme trend line. So the words extreme and local, okay, you don't confuse the word extreme for something crazy, right? Because extreme, usually people associate that with extremism, Like, whoa, that's crazy. It's extreme. That's not what this means. Extreme just means it's more like your extremities, like your fingers and your toes, right? Your body has extremities, which are, the outermost points of like your fingers and toes. Those are called your extremities because they're on the extreme outside of your body's composition, right? So in trading, it's the same thing. You could have your extreme trend lines, and then you could have like inside, you can zoom in and find a smaller uh, period of price to draw a smaller trend line. Okay, so how does that relate to the alerts? So the alerts, we have extreme reversals and local reversals. And I pulled up this chart here. This is gold. And the reason I'm using this as an example, I zoomed out on the 5-minute chart here, is because it's perfectly showing extreme and local reversals. So if you notice, the yellow alerts are on the extreme reversal points. Okay, so those are major shifts in trends. Okay, on a, relatively speaking, on a 5-minute chart. And then the green and red alerts, you could see there's a green buy right here, a red sell, and a green buy. Those are local reversals, so they're inside. Okay, so you have your outside and your inside. So the yellow alerts are actually counter trend trades. That's what those are, right? That's from what we've been building with Stacked and all the different engines. It's an extreme reversal point, but it's a counter trend trade. So two things that are very, very important to know about the yellow alerts is, number one, they're the riskiest trades. Why is that? It's because it's literally an alert telling you to trade opposite of the trend. And that's always dangerous, to trade against the trend. However, they will also always be the most profitable alerts out of the entire system. They won't have the highest win rate, but they will have the highest profits. Okay, so for example, just comparing this sell alert here to this sell alert here, that's a perfect example, right? This sell pretty much expired right there. That was the most you could have got out of that sell. You could see that this one ran a lot deeper. Okay, you could see this buy alert down here, the green buy, that's a local reversal. That just means that it's in the short-term trend is going down short-term, right? And so then there's a local reversal. That means there's a buy, right? And the goal of this buy is to make a new high. Okay, and you could see that it pivoted again and it ended up coming here to make a new high. So it still reached its target, but it pivoted first. Right? Now let's compare this buy alert right here. You see how far that ran versus look at this buy alert down here. Right? How far did this buy run up before you got a counter trend sell, right? It ran up way bigger. Okay, so that's very important to know. So for example, like today on US 30, the market was oversold and the market was trending bearish most of the day, which I'm going to teach you all some advanced understandings of certain things within the market. Today it was most likely that US 30 was going to be bearish, and that's because after the market open, if you guys were there this morning on the market open call, the market ran way up and then it reversed, and that period of time that we talk about between 9:30 Eastern and 10 a.m., most of that area was bullish, and then price quickly reversed and it came all the way back down and rejected that entire bullish swing. And so when you see that, that's an indication that that's how the rest of the day is going to go. Usually how the open finishes, that whole period, let's say from 9:30 to 10:30, give or take, sometimes 9:30 to 11, that period of the day, however that period finishes, is usually how US 30 is going to trend for the rest of the day. About 70% of the time, right? Not always. I mean, some days are just rangy. Some days have major reversal points depending on why and what's going on. But it was pretty obvious to me today US 30 was going to be bearish. The market was oversold. And so I only saw yellow buy alerts coming in on US 30. Now, what's very important to know about the yellow alerts is that I'm going to start zooming in here. So in fact, we can go to US 30, but I did reset my chart. So I only have that last alert that came in at the end of the day, which was a really nice runner there at the end of the day. That was a nice buy alert. But there was some buy alerts in here, but they're no longer on my chart. So I'm wondering if I can go to NAS. NAS was just unbelievable today. Let me know in the chat if you guys traded any of these NAS alerts. It was, since the market opened, it was 4 for 4. All 4 of them were winners. Really nice alerts. But again, what we're looking at here, you see there's a yellow sell. Okay, that's your extreme reversal. So that's going to give you the biggest potential reversal. And then you can see you got a green buy. Okay, so that's going to be a smaller local reversal. Okay, that's almost like it's trying to continue up from all of this activity, right? It's almost like a pullback continuation alert. And then you got a yellow buy. And so when the reason it went from green to yellow is because now this market was officially oversold on the 1 minute chart, and it was looking for an extreme reversal. And that's why it also came back for another yellow buy. And so what you'll see is the market will range from buy to sell to buy to sell, right? In general, it goes up and down, up and down. And at those extreme points where the market actually decides to turn around, that's where you're going to get your yellow alerts. Those are the best alerts, right? So you definitely want to be ready to take yellow alerts. And we're going to talk about that. But you also have to use the most amount of caution on the yellow alerts, because the software is trying to call a major trend reversal with the yellow alerts, and it could be premature. Okay, now if you get several alerts in a row, several yellow alerts in a row, what I've seen so far with all the testing we've done, this was all forward testing, of course, in real time, is that it's just an inevitable amount of time. The market's going to give way, and then there's going to be a huge break in the direction of the alerts, right? So what that means, for example, is you may get, 3 or 4 yellow alerts because the market is trying to reverse, and there's going to be one of those last yellow alerts where the market's going to break, and then it's going to drop like a rock, right? And you're going to want to be, in those positions. Now, a couple of things about these alerts. Number one, you guys notice there's pullback lines, right? Pullback entries. On yellow alerts, it's my opinion that you should really use the pullback entries for your entries on the yellow alerts. Now, just so you know, these yellow dashed lines are literally the entries for the trade. That means if you get in on the candle that triggered the alert, that's not the entry. That's where the alert popped up. That's your confirmation candle, but that's not the best place to buy. Like in this example with this buy alert, getting in at the top of this candle is not the best place to buy. Number one, if you look to the left, you're going to hit some resistance immediately. And then number two, if you want to be smart, right, you want to trade like a hedge fund trader, right? You wait for a pullback. You wait for a retest. Okay, so you could see price made this little double bottom here, came up. There was enough confirmations within the software to trigger an alert, right? And you want to wait for a pullback. Now, this one never gave you a pullback. It didn't give you that chance. And so that's where I'll just tell you what I do. What I do is I always put in a trade immediately. Okay, even though I know it's not the best place, right at the top of that candle, I will put a buy in, but I'm using a lot size that allows me to also cost average here at this pullback entry line, and also to cost average again down here. And all 3 of my trades are equal to the amount of risk that I want to have total. But the reason I get in right away is because in situations like this, sometimes you don't get a second chance. You know, the market takes off and you're like, oh, I wish I was in. Or you could see down here on this buy alert, it almost came down to that line, but it didn't quite make it, right? So if you're waiting for a pullback again, you would have missed it. And then the market took off in a big upswing. And so you would have missed the trade. So if I'm sitting at the computer, I don't want to miss trades. The worst thing to do is I'm sitting there staring at the chart, an amazing alert comes out, the market goes in my favor, and I completely missed it because I was waiting for a pullback. That's why I get into the trade right away. But that is a little bit more aggressive, just so you know, because that's not the actual entry for that alert. The entry is the actual pullback line. That price is the actual entry that the software is identifying as the price that you want to get in at. So if a conservative trader will not just get into alerts. A conservative trader is going to always wait for pullbacks. If the price didn't pull back, then he's just going to miss the trade. He or she is just going to miss the trade, right? I like doing both. Now, and here's I'm going to show you something that I do, and it takes practice, and you got to be a little bit quick, but I've been able to have almost a 100% win ratio. Let me know in the chat if you want me to show you how you can have a nearly 100% win ratio on every single alert, even the yellow alerts that have the highest amount of risk. Let me know in the chat, and I'll show you right now. Okay. All right, just testing you guys, making sure I'm talking to the right crowd here, a crowd that wants to make some money, right? So if I get an opportunity to cost average, okay, so for an example, let's say I get in immediately right here, that's position number 1, okay? Let's say I cost average right here, and then I cost average right here. If I'm in that situation, if I end up seeing that the market, let's say the market did come down through these levels and retested down here and then started to go up, by the time price is back to around right here, I'm usually in an overall profit on the trade. So what I'll do is I'll wait until these 2 trades are giving me enough profit to where I would normally want to close my trade for a profit. Okay, so sometimes I'm in like, let's say price just gets back to here. It doesn't even get back to this point here. So just between the profit on this trade and the profit on this trade and a little bit of drawdown on that first trade because price hasn't gotten back there yet, I'm in enough profit to where I can close these 2 trades and bag some profit, just like you see Coach Mo do in the mornings, right? You see Coach Mo almost every morning. What does he do? He always says, I'm going to close one of my trades to take some profit, tuck some profit away. That's very smart to do that, right? And that's how I trade the yellow alerts, where I will close 2 of my 3 trades to tuck away some profit. And then I will set this trade to break even with my stop loss. And then I will pretend like it doesn't exist. Now, I understand that that is a difficult discipline to do, holding on to your trades. It's a difficult skill to master. But the reason why I challenge you to learn how to take multiple positions, okay, so if you don't like cost averaging, then split your lot size in half and just take 2 positions right here at the top. So it's the same risk, right? For example, if you always trade a 0.02, well, then just take 2 trades at 0.01. And on one of your trades, close at an amount of profit that's a part of your plan. And then the other trade, leave it set to break even, and then convince yourself that it doesn't exist. Why am I saying that? Because these new REV alerts were not designed for small scalps. They're not designed for small moves. Now, granted, the red and green alerts are going to be usually smaller alerts, smaller moves than the yellow alerts in general. But the alerts overall were designed for major moves, especially the yellow alerts. The yellow alerts are designed to try and get you into profit and for that trend to run for sometimes days at a time. Okay, days at a time. So, for example, if you got into this sell alert that came out today on NAS, and you had one of your trades set to break even, right? So let's say let's zoom in on this, and let's look at this in real time. Okay, so let's pretend like this is a real alert that came in. How would we want to trade this? Okay, first off, here's the confirmation candle right there. That's the candle that produced the alert. Okay, so let's say you get into a trade right here, and then price retraces a little bit to retest. And as it crosses this yellow dashed line, you put in a second position here. Okay, the very next candle takes you back towards your profit. You know, right here, you're kicking butt because now you're in profit on both of your trades. According to your plan, you need to decide when you can either close this trade here or close this trade here, either one, right? This one's going to have a little bit more profit because you got a better entry, but it's up to you which one you close. And then you set the other one to break even. Now, which one do I close? I would close this one here. Why is that? I would close the one with smaller profit. Why is that? Because I want to see how long I could let this one here run. And it's further away from where price is at. And so I have less of a chance of getting stopped out, less of a chance of it hitting my stop loss. Right? Now, granted, let's touch on that. Where should your stop loss be? Your stop losses should be above the last swing high, just above the actual dashed line, right? That's on the chart. That's the last swing high. Now we're going to show you some advanced strategies on different places to put your stop loss for tighter setups, but not today, okay? But I want to show you if your stop loss is up here and price is right here, this would be too soon, right? One candle is way too soon to move your stop loss to break even because you have a very high chance that price is going to always retest. Price loves to retest always, right? And so you have to wait for an actual break, right? It's called a break of structure is what it's called. For me, that's what I use. My rule is if I see a break of structure, that's when I start getting ready to move my stop loss to break even. What structure am I talking about? I'm talking about this structure right here. Okay, that's a support right there. You can see that price came down, bounced up, came down, bounced up, came and wicked through, came back up. This line right here, that's support is what that is, right? The buyers were trying to pull some weight here and to push the market back up to continue the trend, right? But they were unsuccessful. And so then you saw a candle close. That's the key. You saw a candle close on the opposite side. This was not a break of structure. Why? Because the candle didn't close below. It came down temporarily and then it wicked right back up and then went to the north side, right? So that wouldn't be, you wouldn't want to assume that that's going to be a break of structure. Now, once I see this and then it comes back to retest that support, and remember I told you guys on Friday, and I'm going to keep teaching you this, supports become resistances and resistances become support, right? They like to flip-flop. And so this exact same line, that's support, now becomes resistance. There's a rejection. That's your confirmation right there. Once I see this candle here, that tells me now I could move this to break even and then forget about it. Now, remember, I already closed this trade right here for profit. So I tucked away some profit. So I'm growing my account. But then on this cost average trade, I'm finally in a position down here where I could set it to break even with a low chance of getting stopped out too early. Why do I want to do that? Why do I challenge you to do that? Why? Is it worth it? Well, let's zoom back out. If I would have left that trade set to break even, okay, look at where the trade was at, up here. And then you pretend like it doesn't exist and then just let it run forever, right? Now, granted, by the time price is down here, I mean, can you fathom the percentage of gain that you've made on that one trade? Because you had the guts to let it run and you already took your profit on your first trade. If you learn how to do this, I'm telling you this, this is why I designed these yellow alerts. The yellow alerts were designed for these kinds of moves, huge moves. Now, they might start popping up a little bit premature sometimes. Like today, I saw that on US 30. There was a few that came in a little bit premature, right? But they're designed for massive swings. And so, you know, my goal for you is to help you learn how to take advantage of those massive swings. Because if you were risking, you know, a 0.5% on that trade right there, I mean, just do the math. How many times did it go down all the way down here, right? That would have probably been, you know, just eyeballing it here. Gosh, that probably would have been, I mean, at least somewhere between a 5 to 10% gain on the account, and that's conservative. That's a massive trade, right? Those are the yellow alerts. So again, it's very important to understand the yellow alerts are counter trend alerts. So you're going to see them come in when the market is trending in the opposite direction. So when a sell alert comes in that's yellow, it means that the market's been bullish. So it's a dangerous trade. But the more you trade the REV alerts, the more you will realize that those dangerous trades have the highest RR potential, the highest risk to reward potential, because they are going to call the extreme reversal points of the charts. They will give you the biggest moves on the charts, right? And so you could have left that open and you still could have crushed it on this buy alert here, this buy alert here, right? Once you start getting yellow buy alerts, you know, that could be a good rule. I heard someone ask, you know, can you just trade yellow alert to yellow alert? Yeah, you can. The market doesn't always move perfectly like that, right? You're going to have some of your trades hit your stop loss. But in general, the software is going to be calling the highest sells and the lowest buys, and those will be the color yellow, right? So that could be one of your strategies, right? You might be able to, you can see it called a buy here. Let's see if it, where was the last sell before that? So look at that. So I can't really zoom out anymore, but look at the last yellow sell alert that came in. So look at where this was at. I can't zoom out anymore, but look at, I mean, that's how big that sell was. I mean, look at it. Like all of this, right? I'm talking about this sell right here, this sell alert. This is how this was designed, right? It was designed, look at how big of a move this was. Right now, you got a yellow buy alert here. You got a yellow buy alert here. So if you want to use a rule that you just trade yellow sells to yellow buys and then yellow buys to yellow sells, you could try to do that. I just wanted to show you, though, that the moves are even bigger than that. I mean, look at how the market continued to drop and drop and drop and drop and drop, right? That's a 2-day trade, right? If you would have taken that sell alert and then forgot about it and just pretended like it didn't exist anymore, left it at break even, it would have never hit your stop loss, and it would be running into profit for 2 days. And now you're talking on that one trade. Yeah, you had to wait for 2 days, but that one trade is probably a 50% gain on your account. When was the last time you made 50% in a day or two? That's the point, right? These yellow alerts are massive. Okay, and you can see the inside, right? The local reversals. There's a red, there's a green, there's a red. You know, that red was a nice confirmation there. That red alert had a really nice drop. So that's those are the differences between the yellow and the red and green alerts. Okay, so again, yellow alerts are counter trend trades. They're extreme reversals. They're going to call the tops and bottoms. They're the highest, riskiest trade. You have to use a stop loss with the yellow alerts. Seriously, you should always use a stop loss, always. But on the yellow alerts, it's a really bad idea to trade yellow alerts without a stop loss, because the software is trying to predict an extreme reversal point, and it's also against the trend. So you have the higher probability that you're going to lose. But the ones that win, you could lose 3 or 4 or 5 yellow alerts in a row. Usually that doesn't happen, but what I'm saying is that you can, if you have a tight stop loss, you can lose 3, 4, 5. the software will call the top or bottom. It will. You'll see. Right? If you lose 3 yellow alerts in a row and you have a tight stop loss, so you lose a little trade, lose a little trade, lose a little trade, and then that fourth one is a banger, it's going to run and it's going to make 10 times more profit than all of your 3 little losses combined. That's the point, right? It's a very smart idea. If you have a small balance in your account, or if you're conservative, to use the actual pullback entry lines as your entries on the yellow alerts. Okay, because most of the yellow alerts, they will get retested. They will retest those pullback entry prices, right? So that's really good data to know. That's really good to understand. If you look at the yellow alerts, just look at, so let's go through them real quick and see if how many yellow alerts had a pullback. So let's just start from this buy. So that one did not reach it. Okay. That's a green alert. Okay. That's a yellow alert. It didn't quite reach your pullback. Okay. So again, if you're conservative, then you'd miss those trades, right? This one breached it, right? You could see it did. It would have been a really great idea. Now, this is very powerful stuff. Okay. Because if you look at your risk to reward, okay, from here to your stop loss, it's only $13. But from here to your stop loss, here's which is the candle. It's actually right there. That's the candle. From here to your stop loss, if you got in immediately, it's $48. Okay, that's why the pullback entries are so amazing, to either wait for the pullback to get in or cost average to give yourself a better advantage. I just showed you the difference. This is a $46 pullback to your stop loss versus the pullback price was $13. So $13 of risk versus $46 of risk. That means that from that pullback, right, this you actually would have got in at the actual yellow line, right, if you were using that as a rule. So let's see, that actual pullback line is $21, so it's still half the risk. And you could see, but if price even just gets back to the confirmation candle top, if price just gets back to where it already was, which you have a high probability of that happening, you're already in a 1-to-1 profit, right? If it goes here, look at that, you're already at a 1-to-2 profit because you waited for the pullback, right? The pullback entries are deadly, right? And you'll see that a lot of times price does try to come back to test those pullback lines, right? We're going to continue to monitor the pullback entries. You may see some modifications to the actual pullback locations because we want to continue to make sure they're deadly accurate. You could see price it came way through on that one. This is a red alert, but you could see it went through. So what I'm showing you here is I'm showing you how many times you get an alert and then price goes back to retest the pullback entry. You could see on most of the alerts, they do. That's the point I'm trying to make with you right now, is that most of the alerts, price will come back and pierce a pullback entry line. Why is that good to know? Because if you want to be conservative and you want to have high risk to reward setups in your trades, there's nothing wrong with not getting in right away and just waiting for a pullback. Nothing wrong with that. You will have plenty of opportunities to make money by being patient and waiting for a pullback before you get in. Because remember, the yellow lines, those are the actual entry lines. These alerts are way different than the post-date alert system. The post-date alert, it's an immediate entry, right? There was no pullback. But the REV alerts, the pullback is the actual entry. So if you get in before that, you're getting in actually ahead of the alert. So an alert on the REV system is not just because an alert pops up on your chart, just so you know. That's my point. An alert is when price goes to the pullback entry line. That's the alert. So you have to see the word buy or sell, and then price has to go and pierce a pullback entry. one of those yellow lines. That's the complete setup. That's the trade. So if it never does that, then that means it was an invalid alert. It never validated itself. Just so you know, that's how we designed it. Okay. So I'm not going to harp on that much more on this call because we have several things to get through. But I just want to show you that the yellow alerts, they look a little funky when you first start seeing them pop up on your chart because you're like today on US 30, like, why am I getting buy alerts? The market is so bearish because it's trying to call the bottom of the market. And you'll see, give this a few days and watch where the alerts come in and you're going to be like, dang, those yellow alerts are crazy. Those yellow alerts are always the most insane alerts that you can ever imagine. So, and the green and red alerts, those are the engines that would have been used for like continuation of trend alerts. Now, let me show you something. I'm going to go to US 30 and I'm going to show you the different trend settings that you have built into the system. Okay, so I'm going to right click. I'm going to go to indicators list. And you can see right here, I got REV alerts. I'm going to click on that. And you can see the current trend mode that I have it set to is none. That's why my candles just look normal, right? But we have two different trend settings built in. There's candle trend and ribbon trend. And I'm going to explain the differences because these are powerful. They're powerful because watch what you can do here. I'm going to start with the ribbon trend. The ribbon trend is my personal favorite. If I had to choose between candle and ribbon, personally, I would choose the ribbon, but it's all just a matter of preference. All right, so I'm going to turn on the ribbon trend, and then I'm going to apply that to the chart. Now watch this. Okay, so the ribbon trend, it applies a ribbon, a colored ribbon that's either red or green. And that ribbon that's running across the screen, those are not candles. You can see the candles are actually gray. They're grayed out. And the reason they're grayed out is to give you a distinction between the ribbon and the candles, right? Because if you saw a bunch of red and green candles combined with a bunch of red and green ribbons, the chart would look convoluted. It'd be hard to distinguish the ribbon, right? It's important to know when the ribbon is red and when the ribbon is green. Now watch this. Today was a massive bearish trendy day on US 30. So imagine on a strong trendy day, if all you do is wait for the ribbon to change from green to red, and then you place a sell trade, right? That's very powerful. The ribbon is an amazing trend identifying tool. So on US 30, what you could have done today was simply wait for the green to go back to red, which shows a continuation of trend, and place a sell trade and just let it ride, right? You could have caught, the whole move, or you could close it when the ribbon turns green again. But the ribbon, here's what makes it so powerful, is you can use the ribbon as confirmation if you want to get into a yellow alert. So you can take the yellow alerts if the ribbon just changed to the new color of the alert. So let's zoom in. Okay, this last buy alert that came out today on US 30, it was a solid alert. You could have waited, right? You have to be patient, but you could have waited for the ribbon to turn green before getting into the buy alert, right? And you would have had virtually no drawdown on that trade, and you could have held it until the ribbon turned red, right? Now, there's going to be yellow alerts that come out where the ribbon never changes colors. Guess what? Obviously, that's going to be a losing yellow alert. If the ribbon doesn't change colors, that means that yellow alert is going to be a losing alert because the trend is still continuing in the direction prior to the alert coming out, right? And so you can use this as a filter, use the ribbon as a filter for the yellow alerts, because sometimes you'll see a yellow alert come out and the ribbon hasn't changed colors. That means the ribbon is still red and it never goes green, and you avoided that trade altogether, right? So it's an awesome system of confluence. Now, let me explain the difference between the ribbon and the other trend setting that you have now available to you, which is the candle trend. There's the ribbon trend and the candle trend. Okay, the ribbon, this is more aggressive. This is designed to keep you in the trade longer. All right, it's less reactive than the candle trend. So let's count real quick how many times the ribbon turned green on this downtrend, right? So once it started red, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 before it bottomed out. Okay, so I just counted it turned green from the top of the market all the way down to the bottom here. It turned green 11 times. Okay, now watch this. If we go back to our settings and we go to the candle trend mode and I activate that, look at that. This is more sensitive. It's not as aggressive in terms of how long this can keep you in a trade for. Look how many times it turned green. Okay, this is the candle trend setting. So the ribbon went bye-bye. There's no more ribbon. These are actual candles, but these are Heikin-Ashi candles. Okay, so the way these candles are designed, they're still designed to try and keep you in the trade longer so that you don't close yourself out too fast and lose out on potential profit, but they're not going to keep you in as long as the ribbon. You could see it turned green 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36, 37, 38, 39, 40, 41, 42, 43. So I mean, it turned green almost 50 times from the top to the bottom versus the ribbon only turned green 11 times. Okay, I'll zoom in so that you could see what these candles look like. These are called Heikin-Ashi candles. So these are pretty cool because they'll show you overall where the very short-term trend is going with the market. So on regular candles, you'll see a lot more green and red, right? Like on regular candles, you probably had some green candles here, but it's showing that there was still some strong bearish momentum, so it kept it red. So this is more reactive. It's a little bit more sensitive than the ribbon. And then, of course, you can take those off by just going into your settings and just going to none. Okay, and there you go. There you go. Look at all the green candles that were in here versus the Heikin-Ashi was showing that this was all red because it's still showing there's large bearish pressure, there's wicks, right? So all of you are different. Everyone's going to have a different preference on if they want to use either one of those trend settings. The key is I wanted you to understand the differences. Okay, the ribbon is bad to the bone. A ribbon can be used to confirm whether or not you want to get into a yellow alert. It's going to keep you into a trade longer because it's not as reactive. It's a little more aggressive. Then it's also an excellent tool if you want to trade with the trend and get into a continuation of trend entry when the ribbon changes colors on strong trendy days like today. Okay. I'm going to open up the chat here. I'm just seeing if there's any important questions here. I'm going to open up the Q&A. Okay, let's see here. If the yellow trade doesn't retrace, do you try to enter a little late or do you just wait for a different pullback later? Great question, Gary. Great question. So Gary asked if you're late to the party on a yellow alert and there's no retracement, do you still try to get in? Me personally, I do not. Just so you know, meaning first off, I get in right away before a pullback, but I also cost average at the pullbacks. That's how I trade them. But if I miss that initial entry and price is already running away from me, then I don't get in. I just move on because I mean, between the 5 charts, there's like 30, 40, 50 alerts a day. sometimes many more. So it's no big deal. I'll just wait for the next alert. How long is the alert valid? Great question. So these alerts are valid for a good amount of time. It's really just based on what's happening with the price. So for example, if I go to a 5-minute chart, like let's say we go to gold, and let's zoom in on what gold did today. Gold was incredible. So you could see late in the day, we got a buy alert on gold. So these are 5-minute candles. So you could see we have 5, 10, 15, 20, 25, 30 minutes, 35, 40, 45, 50, 55, 1 hour, 1 hour, 5, 10, 15, 20, 25. So all of this right here for me is still a valid time to get into this alert. I could still get in, even though price has already been moving for an hour after the alert came in. Why? Because it's still within the zone of my setup. Okay, this was the alert candle right here, and you can see price is just above the alert candle. Okay, here's the alert candle, and look at where the price is at. Right? That's an excellent pullback right there. That pullback entry is money, because you could have a bigger lot size on that little setup. And look at how powerful this is. If this was your entry on that pullback, okay, and your stop loss is down here, when the price gets back to here, you're already at a 1-to-1 profit. When price got to here, you're already at a 1-to-2 profit. You could do that all day, every day on these alerts. It's insane if you understand the power of a small setup. Okay, I want to show you that one more time, because most of you are new traders, and you have to understand the power of these setups. Here's the confirmation candle. That's where the alert came out. But let's say you either got in right there, or you waited for a pullback and you got in right here, or you cost average right here. Where's your stop loss? Your stop loss is just below the last swing low, which is underneath the yellow dashed line. So your entire setup is here on that trade. That's the whole setup, right? When price gets equally as high as it is from here to here, we measure that exact same distance here. That's already a 1-to-1 profit. That means if you're risking 1% on this trade, you're already back in a 1% within one candle. You're in 1% profit. When price gets to here, that's already a 2% profit. And price hasn't even left the zone of the setup yet, and you already have a 2% gain on your account. If you start doing the math on that and letting some of those trades run, that's what I'm saying. We're going to teach you how it's possible to make 10, 20, 30, 40% gains on one trade. And it doesn't even take that long, especially on a 1-minute chart. Oh my goodness. On a 1-minute chart, you could get into a 5 to 10% gain on your account within like 6 minutes, because it's all just based on the setup. And so if your setup is really small, the distance between your entry and your stop loss, if that's a small setup, then guess what? You only need like 4 or 5 candles in your favor to just crush it like crazy, right? That's why these were designed. So how long are alerts valid for? As long as they're within my zone, like as long as they're still around the setup area, it's still totally valid. And sometimes, I mean, it could be an hour. Sometimes it could only be, if you look at this sell alert right here, I mean, within about 40 minutes, price already moved way away. And so it was no longer valid. Right. But that was a wonderful sell alert. By the way, I'm going to continue to test if you guys want to test along with me. This was pointed out today by Mr. Tim Phillips from North Carolina. You're going to be hearing from him on calls. But this is Euro AUD. He pointed this out, and he thought that it would work good with this REV Alert system. I hadn't tested it, so I ran it today, and it crushed it today. Look at that sell alert. I mean, just a beautiful pullback entry, huge drop. The buy alert came out a little bit later in the afternoon, and that was also a winner. It was really nice. And you could see how the REV Alerts is measuring the markets, right? Look at that buy alert down here. That buy alert right here was still a winner. Right, you can see that buy alert. So here's another good picture of look at where this sell alert is versus this sell alert. Your yellow sell alerts will always be at a higher price than your red sell alerts. Okay, here's what I want to cover now. I want to talk to you guys about what times of the day to trade. And if you, I wonder how I should do this. Let me see. Let me go to my, give me 1 second. So I want to write this for you. Let's see here. I'm going to pull up, let me pull up a PowerPoint slide real quick for you. So I could add some notes to the screen. All right. Very, very important to understand this. Okay, perfect. Can you guys see my PowerPoint screen?
Yes.
Perfect. Thank you. All right. I have all these menus in my way. Sorry. There we go. So funny. My Zoom menu keeps popping up and blocking me from being able to type. Okay, there we go. All right. US 30 and NAS. We're gonna send out a chart for you. Okay, to have these. But you really need to know this. I'm gonna show you the 2 times of the day that I don't trade US 30 or NAS. And this is from me running this system for months, every day. So I know it like the back of my hand. I know when the alerts are really good, and I know when I stay away from the alerts. So this is when I do not trade. Okay. Between 7 and 8 a.m. Eastern. All right. That's one of the times. Let me, this is critical. That's why I'm going through this a little bit slowly. Okay. Because for whatever reason, it's a weird time of the day where the market is transitioning where like London, which kicks off at 3 a.m. Eastern. London is like halfway through their day. So I don't know if all the London traders go on their lunch break or something. And then New York hasn't opened up yet. And so the market gets kind of sluggish and it gets weird between 7 and 8 a.m. Eastern. So I do not take alerts at that time. I used to run into my office every morning and start trading like at 6:37. And I pull up my charts. There was like 6 consecutive winning alerts while I was sleeping. And then I take 1 or 2 alerts between 7 and 8 and I kept losing. And I'm like, gosh, just my luck, right? It's like, why do I keep losing? And I realized that it's every day that the market just has that weird period of time where London slows down. New York hasn't opened yet. Asia's asleep. And there's not really good alerts. Guess what? The exact same thing happens between, let's see here, and between 11:30 a.m. and 1 p.m. Eastern. The same thing happens. So 2 of those yellow alerts that came out today on US 30, if you go back and look, they were during this period of time. Now, me personally, I'll share this. If some of you want to trade the way I trade, I'll never do something different and tell you to do something different than what I'm actually doing. I don't trade between 11:30 and 2 p.m. for me. But I do tend sometimes to miss some really awesome alerts after 1 o'clock, after New York picks back up. So between 11:30 and 1, all the New York traders go to lunch and the market becomes really sluggish and slow and you get some weird alerts sometimes. So I do not trade at that time. I personally don't like trading until 2 p.m. But if you wait until 2 p.m., just know you're going to miss some good alerts sometimes between 1 and 2. So it's totally okay to start trading again at 1. But if you traded between 7 and 8 Eastern or 11:30 and 1 p.m. Eastern on US 30 and NAS, you're going to have iffy results. And that's just because that's how the market moves at that time. It gets sluggish and slow and volatile and weird. It doesn't really move in any major trend direction. Now take that with a grain of salt, right? Sometimes it does, but it's very rare. Okay. But very important to know that schedule so that you're not like, oh my gosh, I keep losing, but I'm trading at the worst times of the day. Guess what? Any other time of the day is amazing for US 30 and NAS with the REV alerts. This is unprecedented for us because we've always talked about how Asia is a terrible time. Trading around the market open calls is not good. This is different. These alerts are totally different. Okay, I do take alerts at the market open, and Asia kicks butt. Asia opens back up at 6 p.m. Eastern. It gets going at 7, 8 p.m. It starts cranking, and the alerts are just fire. I mean, it's just amazing. You could scalp all night long. I mean, it's just insane. Okay. All right. GBP pairs. We have two of them. We have GBP AUD and we have GBP JPY. I trade these pairs between all of Asia. Okay, so when the market opens back up, Australia is kicking off, Japan is kicking off, right? Both of those are against your GBP pairs, all through London. Okay, so about 6 p.m. when the market just starts to open back up, they say it's not smart, to trade in the first hour or two of the market. So that's fine if you want to wait till like 8 p.m. Eastern. So 8 p.m. Eastern until London closes at 11:30 a.m. Eastern. That's it. Okay, so understand that every day at 11:30 a.m. Eastern, London is shutting down for the day. Asia is asleep. And look at the pairs, the Great British Pound versus the Japanese yen, the Great British Pound versus the Australian dollar. All of those markets, right? Great Britain, they're done for the day. There's no more volume on GBP. Japanese and Australia, they're asleep. There's no volume there. And so I don't take alerts after 11:30 a.m. Eastern on the GBP pairs. And it's the exact same for gold. Okay, gold is the same. Right? If you're testing that Euro AUD, I'd follow the same logic. Okay, now I'll explain something real quick and then we're going to move on with the call. But so just to reiterate, right? Indices right here, US and NAS, between 7 and 8 a.m., no trading. Between 11:30 and 1, no trading. You'll get alerts, but I don't take those alerts because they have the highest rate of losing alerts at that time. And then GBP pairs, I'll go from 8 p.m. Eastern all the way to 11:30 in the morning the next day, and then stop. And then it's the same with gold. So gold is 8 p.m. Eastern until 11:30 a.m. Right, and it's pretty consistent throughout that time. Understand in general, trading after 11:30 in the morning Eastern, in general, that block from 11:30 to like 4 p.m. Eastern when the market starts closing. That's a lot of traders, they don't like trading in that block. They don't like afternoon trading. All you have is New York. I personally I catch some runners on US 30 and NAS at that time of day. That's why I like it. But if you could become good at getting most of your results done in the mornings when it's convenient for you or at Asia, you're much better off. Okay, just letting you know that. The market will never be as good in the afternoon as it is in the morning in America. That's just the way it goes because you're going from multiple regions of the world pushing prices to only one in the afternoon, right? So that's just good to know there. So what I'm gonna do,
Hey, Sal, real quick, I'm sorry to
Yes.
interrupt you.
Mhm.
Can you just clarify that? Because it kind of seems like if you can at least write on the top, don't trade, and on the bottom, yes, trade. I think some people were taking screenshots of that section there on your PowerPoint, and it's very helpful. Such great information.
yeah.
But if you can just put no trading for indices, yes, trading for GBP pairs, that's amazing. Thank you so much.
Yeah, okay, so then I'll just do, yeah, I see what you're saying here. Look at that. I'm over here making confusing stuff. All right. Eastern to 8 p.m. Eastern. And then I'll do this. Gold. Okay. If you guys want to screenshot that right there, when not to trade. US 30 and NAS between 7 and 8 Eastern and 11:30 and 1 Eastern. I personally wait till 2. GBP pairs and gold, which are the other 3 charts, we do not trade between 11:30 and 8 p.m. Eastern. All the other times are wide open. The REV alerts will give you a lot more trading opportunities than the post 8 alert system, right? Because the post 8 alerts, we had several blocks throughout the days where we didn't have as much success, right? This is a little bit more broader scoped, and it gives you more opportunities to trade. So we'll create a nice chart and we'll send that out to everyone so you can use it. But in the meantime, like if we don't get you that chart till tomorrow, we'll then understand that tonight and tomorrow, follow this as a guideline if you want to get the best results. So thank you for that, Vanessa.